The Australian dollar mostly had a good week, reaching 6-week highs against the US dollar, just short of 77 cents. Some of its strength was, as we suggested last week, when we noted that the signs were promising for Australia to report strong growth in Q1, in contrast with the likes of the US, UK, Japan and Eurozone, which all reported a soft start to the year. Australia's economy grew 1% in Q1, taking annual growth to 3.1%, the fastest pace since June 2016. A sharp improvement in net exports was the key in the GDP acceleration from 0.4% in the fourth quarter of 2017 to 1%. Simply hitting the 3% headline growth rate that the RBA and Treasury have been projecting for 2018 and 2019 is a clear positive for the Australian dollar that should persist for some time. But outside exports, the details of the GDP report were not so encouraging. Business investment and residential construction made minimal contributions to growth. Household consumption rose just 0.3%, despite the savings ratio falling to 2.1%, a low since 2007. And growth was unusually reliant on a burst in government spending, especially consumption, rather than investment such as infrastructure. So there are reasons to be wary of the simple 3% growth handle. But overall, the GDP report was a positive for the Aussie dollar, and the data in the week ahead should reinforce the cautiously positive mood, including May business confidence, June consumer sentiment, and May employment. Commodity prices are also more supportive for the currency, with a basket of Australia's key commodity export prices at a 3-month high. Iron ore is subdued, but strong demand from China has helped prices of Newcastle coal reach 6-year highs, while liquefied natural gas prices are at 3-year highs. If commodity prices remain supportive, the Australian dollar could resume its rally to above 77 cents over the week. There is a lot to watch outside Australia in the week ahead. We expect the meeting in Singapore between US President Trump and North Korean leader Kim will not upset global risk appetite, as both sides will be keen to declare the meeting a success, if only as a photo opportunity. Instead, the focus of global markets will be monetary policy meetings at both the US Federal Reserve and the European Central Bank. Markets prices near certainty that the Fed will raise its key interest rate for the second time this year to a target range of 1.75 to 2%. But there is plenty of scope for volatility as markets look at the accompanying quarterly forecasts. We will also be keen to hear from Fed Chairman Powell. He should be confident about the US economy, but this is no guarantee of a further rise in the US dollar. The ECB, meanwhile, is also sounding more confident, lending support to the euro this week. ECB officials said that despite the turmoil in Italian and Spanish politics recently, they were confident that the Eurozone economy's slow start to 2018 was temporary and that inflation was on track to recover. As such, the officials said that the ECB Governing Council would discuss the timetable to end its long-running program of bond purchases financed by creating money. We will discuss the outcomes of these key meetings when we speak to you next week.